What's going on, everyone? Today, I am issuing a massive red alert because a brand new IRS rule change has officially gone live. And according to the latest surveys, more than 85% of American seniors have no idea it even exists. This is not a small paperwork tweak. This is a fundamental shift in how the government now treats your retirement savings. And if you miss the deadline tied to this hidden mandate, the IRS is legally authorized to seize up to 25% of your hard-earned money in penalties alone. We are talking about a specific provision buried deep inside Secure Act 2.0 and the recently passed One Big Beautiful Bill of 2025, which has now entered its final implementation phase for 2026. This rule is a total game changer for anyone over the age of 50, and it's already sending shockwaves through the financial planning world. Hit that subscribe button right now, because what I am about to show you is the difference between keeping your nest egg or handing a massive chunk of it straight back to the federal government. First, we need to talk about an unprecedented legal bombshell that most mainstream media outlets completely ignored. As of January 1st, 2026, the IRS officially activated what experts are calling the senior bonus deduction. This is not a routine inflation adjustment. Under the new tax law, if you are 65 or older, you now qualify for an additional $6,000 deduction on top of your standard deduction. And if you're married and both spouses are over 65, that becomes a massive $12,000 shield against taxable income. But here's the part that should make your blood boil. The IRS designed this deduction with a cliff-style phase-out. If your modified adjusted gross income crosses $75,000 for single filers or $150,000 for joint filers, that $6,000 bonus doesn't slowly fade. It starts disappearing immediately. This creates what tax attorneys are calling a tax dead zone. Withdraw just $1,000 too much from your IRA, and you could trigger a cascade that wipes out the entire $6,000 deduction, costing you thousands of dollars in phantom taxes you never saw coming. But that's not even the most explosive part. Now we need to talk about the Roth mandate, the quiet weapon the IRS is using to front-load tax revenue on the backs of seniors who are still working. For decades, if you were over 50, you could make pre-tax catch-up contributions to your 401k or 403b. It lowered your taxable income and helped you prepare for retirement. A win-win. That's now gone. As of right now, if you earned more than $145,000 in the prior year, the IRS has banned pre-tax catch-up contributions, completely outlawed. You are now forced to make those catch-up contributions into a Roth account, meaning you must pay taxes now during your highest earning years, instead of later in retirement. Most seniors are going to look at their first paycheck of 2026 and wonder why their take-home pay suddenly collapsed. It's not a payroll error. It's the Roth mandate kicking in at full force. And if your HR department didn't T-warn you, you are already walking straight into a tax trap. So why is all of this happening right now? Because the government is staring at trillions of dollars sitting inside senior-held IRAs and 401ks. And they've realized they can't wait another 20 years to tax it. By forcing these changes, they are essentially harvesting retirement savings early. While only a tiny percentage of Americans are considered high earners, the way these IRS thresholds are indexed means inflation is quietly pushing more middle-class seniors into these so-called high-income categories every single year. You may think you're safe today, but with the 2026 cost of living adjustments, you are statistically more likely than ever to trigger a tax rule you never even knew existed. And just wait until you hear what they've done to inheritance rules. If you are planning to leave your IRA to your children or grandchildren, the IRS has now fundamentally rewritten the timeline for how that money must be taxed. And it can result in a 50% penalty if your heirs miss a rule that was only finalized months ago. If you think the taxes on your own income are bad, this is where things get truly devastating. For decades, families relied on the stretch IRA, allowing beneficiaries to take distributions slowly over their lifetime. It was one of the most powerful wealth-building tools ever created. That door is now slammed shut. Under Secure Act 2.0, the IRS is enforcing the 10-year rule, and as of 2026, they are enforcing it aggressively. Here's the trap. Most non-spouse beneficiaries, meaning adult children and grandchildren, must now fully empty an inherited IRA within 10 years. But under the latest clarifications, if the original account owner was already taking required minimum distributions, the heirs cannot simply wait until year 10. They are now required to take annual distributions in years 1 through 9. Miss just one single year, and the IRS can hit them with a 25% excise tax on the amount that should have been withdrawn. This forces your children to recognize income during their highest earning years, shoving them into higher tax brackets and shredding the generational wealth you spent a lifetime building. Now, there is one narrow opening, and almost nobody is talking about it. For workers and consultants still earning income, the IRS quietly activated the super catch-up provision. If you are between the ages of 60 and 63 in 2026, your allowable catch-up contribution jumps dramatically. Well, the standard catch-up for those over 50 is $8,000. People in this narrow age window can contribute $11,500 instead. That allows a total annual contribution of $35,150 in a single year. But here's the catch. This provision is optional for employers. Your HR department is not required to offer it. If you don't walk into their office and explicitly ask whether their retirement plan has adopted the Secure 2.0 super limits, you could miss out entirely. This is the government ES way of saying, save as much as you can now, because they already know they are coming back for it later. We need to clear up the massive confusion around required minimum distributions, because the goalposts have moved again. If you were born between 1951 and 1959, your required starting age is 73. That is when the IRS forces you to begin withdrawals, whether you want to or not. However, if you were born in 1960 or later, your RMD age has been pushed to 75. At first glance, this sounds like a win, more time for your money to grow tax deferred, but in reality, it's a double-edged sword. By delaying distributions until age 75, your account balance is likely to be much larger. That means when RMDs finally begin, the required withdrawals can be massive, often large enough to catapult you into the 32% or even 35% tax bracket overnight. And here's the part most people never see coming. Those higher RMDs don't just increase your income tax, they can also trigger the Medicare Part B IRMAA surcharge, causing your healthcare premiums to explode. Many seniors Don T realize that a single large RMD can triple their Medicare premiums in 1 year. The IRS isn't handy just taxing your retirement. It's not using your retirement to make you pay more for healthcare. It's a circular system designed to drain the highest performing accounts first. Now let me show you the strategy the wealthiest retirees quietly rely on, the Qualified Charitable Distribution, or QCD. If you're 70, 1 to 2, or older, you are allowed to redirect up to $105,000 per year directly from your IRA to a qualified 501c3 charity. Instead of taking the distribution, paying income tax, and then donating what's left, the money goes straight to the charity. It counts toward your RMD, but it never appears as income on your tax return. Why does this matter? Because keeping that money off your adjusted gross income helps protect your Social Security benefits from taxation and keeps your Medicare premiums at the base rate. It is one of the last legal trapdoors left in the tax code, but only if you use it before taking your regular distribution. If you take the RMD first, the shield disappears. Now we get to the most dangerous threat to your monthly cash flow. The Social Security tax torpedo isn't new, but the 2026 cost of living adjustment of 2.8% has turned it into a financial landmine. Here's how it works. The IRS calculates something called provisional income. They take your adjusted gross income, add any tax-exempt interest, then add 50% of your Social Security benefits. If that total exceeds $34,000 for single filers or $44,000 for married couples, up to 85% of your Social Security becomes taxable. But here's the torpedo effect. Because COLA raised your benefits and RMDs are higher due to market growth, millions of seniors are crossing these thresholds for the first time. For every additional $1 of IRA income, you're not just taxed on that dollar, you unlock 0.85 of Social Security to be taxed as well. That creates an effective tax rate approaching 50% on retirement withdrawals. You're literally being penalized for the raise the government gave you. If the tax torpedo wasn't enough, the next hit comes from Medicare Part B. For 2026, the standard monthly premium has jumped from $185 to $202. That's nearly a 10% increase. But the real danger isn't the base premium. The real threat is the income-related monthly adjustment amount, known as IRMAA. Here's the trap. Medicare uses your 2024 tax return to determine your 2026 premiums. If that return shows income even $1 over the threshold, your premium doesn't increase gradually. It jumps to the next tier instantly. We're talking about monthly premiums rising from around $202 per person to over $600 per person. There is no prorating. If you are $1 over, you pay the full surcharge. Most seniors don't discover this until January, when their Social Security check actually shrinks despite the COLA increase. Medicare and the IRS work in a loop to claw back your benefits before they ever hit your bank account. Now let's talk about timing, because the clock is ticking. The One Big Beautiful Bill created the $6,000 senior bonus deduction we discussed earlier, but this provision is temporary. It is currently scheduled to expire in 2028. If you're considering a Roth conversion, one of the most effective ways to neutralize the tax torpedo, the window is now. By converting part of your traditional IRA to a Roth today, you can use that $6,000 or $12,000 bonus deduction to offset the taxes on the conversion. You are effectively moving money into a forever tax-free bucket at a steep discount. Wait until 2029, and that deduction disappears. making the cost of protecting your wealth significantly higher. Now, for the most urgent warning of all. If you turned 73 in 2025, your required beginning date for RMDs is April 1st, 2026. You must take your first RMD by that date. But here's the trap. If you wait until April to take that first distribution, you are still required to take your second RMD by December 31st, 2026. That means 2 RMDs in 1 tax year. The fastest way to trigger higher tax brackets, activate the Social Security tax torpedo, and slam into the Medicare IRMAA surcharge all at once. Miss that April 1st deadline by even 1 day, and the IRS can impose a 25% excise tax on the amount you failed to withdraw. Yes, lower than the old 50% penalty, but 25% is still devastating on a fixed income. This isn't just about taxes, it's about control. The IRS is counting on you not knowing these birth year triggers, deduction cliffs, and deadline traps. They're counting on passivity. By correctly claiming the senior bonus deduction, using qualified charitable distributions to control AGI, and avoiding the double RMD trap, you can keep thousands of dollars that would otherwise be lost to the system. Watching your raise disappear into taxes is enough to ruin a retirement, but now you have the blueprint to fight back. This is critical information, and 2026 is shaping up to be the most complex tax year for seniors in over a decade. Let me know in the comments, did you already know about the $6,000 bonus deduction, or are you hearing it here for the first time? And make sure you're subscribed, because staying ahead of the IRS is the only way to make sure they do not get ahead of you. Stay vigilant, and I'll see you in the next one.